Friday, January 21st. Still out of town, but heading back. So you can tell, the background is a normal hotel room. I'm going to share with you where I have spent the last few days, which is really freaking cool. It's up just outside of Fairbanks by about, I think it's probably about an hour outside of Fairbanks. Now I got to find where I placed this thing. I thought I had it readily available, but you know how things go. It doesn't always work the way you want it to. Here we go. So just outside of Fairbanks, there's an outfit called the Borealis Base Camp. So my wife and I have always wanted to check out the aurora. And unfortunately, it didn't pop up at all the whole time we were there. There's these cool ass igloos here that they'd set up, all scattered all over the place. You can see the moon starting to rise in the background. And it's kind of hard to tell in this shot, but this whole part of the roof is just open. It's just all clear windows. So you can see the sky. We did get to see a little bit of it, a little sliver off to the left side of what you're seeing here one night, but it was really, really fleeting. Outside of that, there was one really clear night that we were there and nothing. But man, you could see all the constellations were huge, right? The Big Dipper was bigger than I'd ever seen it in my life. And that's how it is every time I'm in Alaska. I think that's probably why the Big Dipper is on their flag. But also the satellites, the shooting stars, everything was really, really cool. But, the main reason we were there for the aurora. Didn't quite get what we were after, but still had an amazing time. So there's no argument with any of that. So today, what are we looking at? This week was a rough one. Scotty had to deal with a lot of crazy quotes he was having to give out because the market being there was freaking out. Remember, I talked about that line. We got below that line. It had a lot of risks there. Well, bonds are rebounding now, and it started happening about Wednesday of this week. They started to get their rebound in late Tuesday, early Wednesday. But Monday and Tuesday, Scotty's giving quotes that were scaring people away. And what the best we can surmise that the reason those quotes were out there and the reason it was that scary is because of that the huge volatility in the market. So let me kind of share the chart here, and we can talk about that a little bit more. So this is what I'm looking at. So this was earlier this week, right? This was Monday. We had this massive drop, and I'm a gap down opening here where we had this on the 17th. So we see that major decline. When you think about the secondary markets, the people that are offering these rates, where it's all coming from these bond pools, when you see that much flow out, they have no idea what's going to happen. They have no idea where the floor is going to be, because when we showed you in the past, these floors could be major drops. In fact, let's just look at that now. I'm going to go ahead and zoom out so we can see what the past looked like when these kind of things happened. And that's a massive amount of money flowing out of these markets. So see, when we hit these levels before, look, this is the same level where we were earlier this week, and look how much it would drop. Look at the significant drop. That's hundreds of points. Same here. When you get to these other drop-offs, look at this drop point, massive drop point, massive drop point. When you're talking about that, there's huge risk, right? Massive drop point. But this was COVID driven. So this one, it's kind of hard to use this one as that particular reason. But when you see these, look at how long it takes to get just half back, right? Crawl back about halfway, another drop. Then they had reason to continue to climb. Now, here's why I bring up this half climb back before we see other drops. Because we had what we show here was this. I'm going to try and get us zoomed in a little bit more so we can talk a little about this in greater detail. Here we go. So we had this gap, right? Had this close here, a down day, another opening on another gap down. Literally, just nobody would buy in until the bid price came in so low that it's well below where they had closed the day before. So you have this gap down opening, and they continued to decline. Big worrisome day. So every interest rate that was being quoted that day or these couple of days was ugly, way ugly. Probably, there's charging points, and it was 8 to a quarter higher than what a 0-point rate should have been, but they were freaking out, right? They're trying to protect themselves. Nobody wants to put themselves in a position where you're trying to, you kind of understand the scenario, right? Where it'd be like buying a stock, right? If you don't want to buy a stock the day before it falls off, right? And completely lose all your money. This is basically what they'd be doing here. So they're positioning themselves in a way to not have anybody jumping in there and locking at that higher rate, or excuse me, that lower rate. But then because the market loses, the rate that they can only offer at the time that it closes is much higher. So it puts them in a very, very negative position. So to avoid that, they do sell a security out on the market that would be a hedge against that, but then they have to have the ability to get that security sold. So there's a good chance that security wasn't even going to sell either, right? So you can see where the risk was. So that's why I had that ugliness in my world. I can't say that was happening everywhere. So I heard some people saying they heard other banks quoting otherwise, but we're dealing with people a little more cautious apparently in this particular world. But when you think about it, what are they doing for us when it comes to doing loans for investors? They're giving us a lot less headache than we get from other places, right? So when we get into the underwriting piece, the actual closing of these deals, we get deals done that most banks say no. Right. But most banks, they're not doing the type of investor loans we're doing. They're avoiding a lot of that because they perceive it to be very risky. Well, in that perception of risk, they can price better because they already have such a narrow window they're going to put those deals in. Right. So when you think about all these things, there's reason for it. But so our people are willing to take a little bit higher risk, but at the same time, they're going to be more susceptible to what's going on in the market because they're taking on higher risk for you. This is for you. This is free money for you. So we closed what I talked about before in gap downs. We're going to see this gap close, right? So that happened, right? We found that, and today it's closed. So that means we've gone up and we've closed up all this area. Now we're sitting at a line of resistance, but I do from the past, and in many places, it's even shown in littler spots, right? If you want to look at it on kind of a micro level and go in and zoom in week by week, you can start seeing that a lot of these drops like to at least recover half. So if you look at our position here, whereas at our very bottom, 101.54-ish, apparently, somewhere right there, all the way to where our top was in this fall off, 103.63, I'm gauging the middle of it being right here where I drew this green line. So if we have this downward channel, which we've been talking about, I'm guessing, this is just a guess based upon technical levels, so we're going to get back, we're going to crawl back kind of sideways and work our way over here to touch this downward channel and be at that halfway point before we start seeing more decline. Now, that there's news that can come out in the market that would force a reversal on that theory, but just theory on technicals, I believe that's where we might go. So what does that mean for you guys? We could see some improvement here and there, but I don't know how long it's going to take. It could take a long time to improve on that rate. So I mean, look at this. Look at these drops. Drop overnight, long crawl back. This is days before it crawled back, right? So this is here. This little situation here, June 21st. Took all the way to July. See here, no, I'm sorry, it wasn't June 21st. That was June 16th, all the way to July 13th or 14th to crawl back. So nearly a month to crawl back sometimes. So it could take us all the way out till March to crawl back here, right? It's possible it could take that long. So I'm just letting you guys know we have some time before it gets there, but I believe it will, just from what I see the market does in the past. So there is a little bit better down the road. So we'll stay in those mid to high fours, but just know with this trend line, we're going into the fives. It's going to happen. It's going to get very, very secure in the fives at some point. Be right with that. Don't freak out about that. I know sometimes at your first year's cash on cash return might suck, but remember, we get to raise rents that second year. I was having a conversation with somebody about that yesterday, how their first year, because of what's going on with the rates right now, is putting their cash flow into a much worse position. There wasn't as sexy of a deal. But remember, you're getting all the money for free, right? Somebody else is paying it back and you're passing it through you. You're keeping a piece of it. And what you're giving them is worth less because of inflation. Then, so not only is somebody paying off the loan for you, right? You're getting all that money for free. On top of that, you get the use of capital for free because you're giving it back so slow, actually getting they're paying you to use that capital. And on top of that, you get to raise rents, even at run your numbers at 3% and 5% rental increases annually. So if your first year doesn't look sexy, and I know a lot of times people are going to look at the first year and that's what's going to drive them to buy something, look at subsequent years, 3% and 5% increases in your rents, your base rent, and see what that does to your cash flow. If your cash flow is small, then you see it increasing incrementally based upon those raises of the rents. You can see how you're going to bridge those gaps really, really, really fast in a couple of years, and it's not going to matter. And I'm one of those types of people. If it's not going to matter in 5 years, does it matter now? So look at it over a 5-year span, decide what you're doing, because in 5 years now, I don't think we're going to have this kind of rate environment. This is a gift today, so freaking yourself out about what's going on in the rate is only hurting you, right? We're going to do the best we can to try and monitor and understand the market, but it's volatile and it doesn't make sense in many places. We got crypto trying to be outlawed all over the world. You got all these things having an impact. All these things have an impact. The problem with us having a global economy is that something happening tens of thousands of miles away affects here. That's the problem we're dealing with, and we can't keep pulse on it. And so my crystal balls is crystals I'm showing you. That's about all I can get, and that's even a very, very educated guess. So I'll do my best to keep guessing and hopefully guess right, just like we did with where the bottom's going to fall out of that, but we didn't know how far down it's going to go. I'm just glad the bleeding has stopped at this point, but take advantage of the rates we've got now, because we're not going to have them forever. I'll talk to you guys on Tuesday.